Hello, listeners. I am Titilola Ogushono, your host, welcoming you to the second episode of our new program series for this quarter titled Financial Inclusion and Economic Development on Amor Gauge Radio Communications. Last week at the inaugural episode, we looked at the concept of financial inclusion, various definitions by various scholars, schools of thought, and among which we mentioned the World Bank definition of financial inclusion, which refers to individuals and businesses that have access to useful and affordable financial products and services that meet their needs, talking about transactions, payment, saving, credit and insurance delivered in a responsible and sustainable way. We went further to differentiate between financial inclusion and financial exclusion. And talking about financial exclusion, we said this referred to people without access to financial services. That when you talk about exclusion, you're actually talking about the challenge, the problem, or the issues. While financial inclusion is the solution, one of the measures of reducing poverty level, achieving economic growth and development in any nation or country. We equally mentioned that financial inclusion can be viewed or can be seen as a catalyst for achieving at least some of the 17 SDG goals, like fostering economic growth and employment. Financial inclusion can be used to promote economic empowerment of women. Of course, it will help to reduce, if not totally, eliminate poverty levels in any country. And of course, we looked at some statistics around the globe. According to World Bank Report 2017, data reviewed a positive relationship, between GDP per capita and account ownership in a financial institution. In fact, it revealed a very strong correlation, about 0.79. That's about 79%. So, the likelihood of you achieving economic growth, development in a nation is strongly linked to the level of financial inclusion in such a country. And definitely, if it's that important, then we need to talk about this. And looking across the globe, progress has been made by developing economies in this area, with about 71% of adults having an account. Okay, so we established all of these things, all of these issues, the statistics, during the inaugural episode that we had last week. So the financial inclusion is crucial to the attainment of economic development of any nation, of any country, of any economy. Why? Because it enables individuals, businesses, corporations, and communities access essential financial services. It helps them to build their assets. It helps them to build and sustain wealth, and while also helping them manage or hedge their risk. Okay, we have the systematic risk, we have the unsystematic risk. Why you cannot control totally systematic risk, that the unsystematic risk that you can control within your purview to control. Financial inclusion, access to financial services would help individuals, businesses maintain, hedge this risk effectively. Thus, on today's episode, we will be exploring the multifaceted importance, relevance, benefits of financial inclusion. We'll be highlighting the critical role that financial inclusion plays in shaping the economic future of a nation. So what are the benefits? What are the benefits, the advantages, the roles that financial inclusion has played, is still playing, could play in an economy? We'll be looking at that. Okay, so the first one we'll be discussing is that having high levels of financial inclusion in a nation will lead to increased savings. The first benefit of ensuring that you improve your level of financial inclusion, number of people that have access to bank accounts, have access to financial services, is that it's going to lead to increased savings in such an economy, because timely and efficient access to financial services the emphasis is on formal financial services, because definitely there are various ways that people could have access to money, payment, the informal sector, but having access to well-coordinated formal financial services would encourage individual businesses to save in a secured manner. Having access to banks, having a bank account would encourage people to save. And when people save, we keep advocating for increased level of savings as economists, because we know that that's the foundation, that is the basis for capital formation of any country. So when people can save, it's going to lead to increased investment levels in the country. So if we have more people bringing their money into the formal, banking sector, into the formal financial institutions, definitely the banks can play, and financial institutions can play an intermediary role. Taking from the deficit sector, from the surplus sector, to the deficit sector. They can play it well than people keeping their money at home. Once that is secured in the banks, financial institutions, it's going to encourage more people to save, and it must be accessible to them. The proximity must be close. It must not be difficult to access these financial services. So one of the benefits of it is that it's going to lead to increased savings, and definitely would automatically, if not almost immediately, lead to increased level of investment in the country. And there's so much consciousness among various countries on the need to improve the level of financial inclusion in that country. A lot of governments have been doing a lot around this area, and I found one notable to mention today on today's program is that of Kenya. In Kenya, statistics has revealed that about 73% of adults have mobile money accounts. In fact, recent statistics that also showed that they have about 80 something percent. Over 80% of adults have a mobile money account. And I looked at it, that what really helped Kenya and what helped them was the introduction of M-Pesa, which was launched in 2007. As at 2006, we had 26% of adults having a mobile money account, but that increased to about 80 something percent in 2021. And what did they do differently? How effective was the M-Pesa? This M-Pesa was launched by the Central Bank of Kenya. It is an SMS-based mobile money service that enables users to deposit, withdraw, and send money. And one thing that they did, which really helped, was that any user was not more than 3 kilometers from an M-Pesa money agent. So accessibility was the key. Was the key factor that helped the M-Pesa effectiveness. Also, execution of this was quite effective too, because there was a collaboration between the service providers and the central bank. So with this kind of arrangement, it's not surprising that they could achieve that high level of financial inclusion in Kenya. So having accessibility is very important. When it is highly mobile, it's not far from the people, where they can save easily. You're going to encourage them to make that payment through the formal financial services channels, which is very important. So the first is increased savings, and increased savings would definitely lead to increased level of investment in an economy. Let's consider the second benefit of financial inclusion, which is improved credit access. Financial inclusion will provide opportunities for individuals, firms, businesses to access loan, credit lines, facilities. Having this access to loans, credit lines, from formal financial institutions tend to be more affordable and efficient, and this will encourage entrepreneurship and foster economic growth and development. And when financial institutions of various countries have these facilities, when they have these loans available to the people, the question is, are the people having access to it? Are they even aware that these credit lines exist? Are they even aware of the opportunities that they could take advantage of? So that's why you need talking about banking the unbanked, banking those who don't have a bank account, banking those in the rural areas. And we've seen government of various nations, being deliberate about coming up with schemes targeting increased levels in financial inclusion. And one of those schemes that I find interesting and also worthy to be talked about on this program today is India. They have what they call the PMJDY scheme. And according to the PMJDY report in 2022, this scheme has been so effective that it led to a significant increase in bank account ownership, with over 430 million accounts open. That's according to the PMJDY scheme report in 2022. And I found it so interesting. I asked myself, what did they do differently? The various schemes that have been introduced by various governments of various countries, and what did they do differently? Okay, and they that thought that was so effective that 430 million accounts were open. It's going to have multiplier effect in the economy. What did they do differently? Okay, so I tried to look at the PMJDY scheme. It was launched in August 2004. It was launched to promote financial inclusion in India. The objective was actually to extend financial services to large underserved population of the country, and also the objective of this scheme was to unlock the country's growth potentials. And it is a national mission for financial inclusion. The acronym is NMFI, and it's almost about the world's largest financial inclusion scheme. Okay, and I chose to look at it, and the aim was for every Indian to have access to financial services. Breaking it down to the kind of services we're referring to, they looked at the basic savings bank deposit account, the BSBDA, looking at remittance. Every Indian should have access to remittance, insurance, pension, and the focus was that all of these must be offered in affordable manner. It must be affordable, accessible. Okay, and this was handled by the Ministry of Finance, particularly the Department of Financial Services, and they had about 6 pillars. Now I found some of these things interesting. What they did, that I would say they were responsive, way ahead to the needs of the people, and if you look further, you realize that this scheme was launched based on empirical evidence. Looking at what the issues are, why the people not banked, those who are unbanked, what were the challenges, where were those factors mitigating having many people into the banking space, the financial services space. Focus was banking the unbanked. That was focused on the unbanked adults. And another thing they did with opening of the BSDBA was that it had minimal paperwork. They relaxed the KYC. They had eKYC. And again, even the account opening was in bank mode. They had zero balance. And another thing they did that I also found notable is that they allowed individuals to open bank accounts. They called them small accounts, or the Chota Kata. And what this small account was all about was that it allowed individuals to open account without presentation of legal document. And also in terms of access to credit, they provided overdraft facilities for them. And what this has done, even initially they had the free accidental insurance cover on their cards, and that really helped. And the outcomes of this, in addition to the number of accounts that were opened, is that it gave them a boost to their digital economy. And in fact, in the long run, the number of zero balance accounts also decreased. So this scheme was very effective, the PMJDY, and even about the largest financial inclusion scheme. So we can see from our empirical evidence that financial inclusion would lead to improved credit assets. The third benefit of financial inclusion that I'll be mentioning now is it could lead to an increase in sectorial investment. It will lead to an increase in investment in various sectors in an economy. Now we talked about balanced growth. There must be growth in all sectors. You must not have just growth in a particular sector, because you cannot achieve economic development if not all, a greater percentage of your sectors are not growing. Okay, so deliberate increase in level of financial inclusion could encourage investment in various sectors in an economy, like the healthcare, when we have more people in that sector having access to financial services, in the health sector, in the educational sector, from the primary to the tertiary, people having access to financial services, which include credit access, even includes insurance, hedging their risk, managing their risk, and even the service sector. All of these will lead to a drive to an increase in economic growth. And of course, I mentioned earlier, the issue of balanced growth, sectorial, all sectors, sectorial growth, when all sectors are growing, definitely that would lead to economic development, all things being equal. And there are countries where financial inclusion is driving growth, sectorially across various sectors. Yes, we have the case of Kenya, we have the case of South Africa, and according to World Bank, we also have the case of a study that was carried out of Bangladesh. And this country, one thing that was strong that came out from that study, that there was a strong correlation between the country's digital inclusion and economic growth. So high level of digital inclusion led to a high level of economic growth. Okay, so that's it. So we have so it's really important that government bringing schemes, measures, approaches to increase number of getting more people that are into the banking space, having access to various financial services, because that would lead to increase in various investment across various sectors of the particular country. If you're just joining us, thank you so much for joining. We've been discussing the benefit, the role, the importance of financial inclusion in a nation or economy, and we have mentioned 3. So the first is that having high levels of financial inclusion would lead to increased savings. I will mention the case of Kenya. We also mentioned the improved credit access, okay, and we also mentioned this particular scheme that was put in place in India, that's the PMJDY. And the third benefit that we mentioned is an increase in sectorial investments. So the fourth benefit we'll be mentioning on this episode is poverty reduction. So having adequate and efficient access to financial services would help individuals, businesses, communities to manage their risk, more efficiently, and would also help to boost future investment opportunities. And furthermore, research has shown that increasing the rate of financial inclusion, particularly in communities that have been ignored or overlooked for a very long time, would help to reduce what we call systemic poverty. Now, when people have access to credit, to financial services, have access to even pension services, it's going to help reduce poverty levels. And taking a closer look at the former financial services for the institutions, research has also shown that the microfinance institutions are the closest to the people, especially in the rural areas, and they have that high propensity to help reduce the level of poverty in a nation significantly. Is there any empirical evidence around the globe to substantiate what I've just said? Okay, yes, let's look at the issue of Bangladesh. Okay, research has proven that microfinance initiatives have contributed to poverty reduction in that country. Yeah, particularly for female participants and also at the village level. Okay, microfinance services that have been made available to those in the rural areas has had great positive effects in that economy. It has helped to increase income levels. Research has shown that it has increased housing and food security. It helped to increase the level of women empowerment. It helped to encourage entrepreneurship, and of course it also helped to strengthen the quality of decision making in the financial space in that country. And also studies, research has also shown that having access to financial services, getting more people into the financial inclusion space in Bangladesh led to a 10% reduction in rural poverty, and that's a lot. And the implication in figures is that we had about 2.5 million citizens, moving away from the poverty line. That is a whole lot. In fact, even WBR report of 2020 shows that poverty head count ratio declined from what it used to be in 2000. It used to be 63.5%. In the 2000, it reduced to 24.3% in 2016. So as a nation, as a country, even a continent, you are looking for the ways to reduce your poverty levels, getting people away from the poverty line. Okay, one other way is to look intensely at the structure, at the schemes, the measures, your strategies that you have in place, existing structure in terms of financial inclusion. If you can look at it and get more people getting, people in the rural areas, the unbanked, into the banking space, having access to financial or the various range of financial institutions, inclusion, financial services done in a way that is efficient, is affordable, is accessible, definitely that is one of the ways of reducing poverty. And research has shown, you see countries, deploy this, and they've been having valuable outcomes. Another benefit of financial inclusion is that it helps to reduce income inequality. One of the macroeconomic objectives of a government is that we want to reduce the level of income inequality in the country. We want to ensure equitable distribution of income. We want to reduce the gap between the rich and the poor. And one of the tools, strategies that nations can deploy is to get more people banked, is to get more people, especially those underserved areas in the economy, in the country, getting them to have affordable, quick access to financial services. The formal channels is quite important to help. In fact, this is a growing concern globally, because there's a report from the United Nations that reveals that more than 70% of the world's population are living in a country where income inequality is growing. So there is concern about growing levels of income inequality. And there have been various research that have been conducted, which are even a lot of international that have been conducted, that shows that financial inclusion reduce inequality at all quantities of the inequality distribution. And when we have some countries with very low income inequality, very low, that the gap between the rich and the poor is low, the level of income inequality in the economy is low, we still have some countries where it is extremely high. So you want to look at those countries and want to look at the financial inclusion schemes that they have, the strategies they have in place. Are they working? Are they getting more people into the formal financial space? Because one of the countries, according to a report 2023, is South Africa. It had the highest income inequality in 2023 with a Gini coefficient of 63. What I would do in maybe one of the subsequent episodes, we'll talk more about income inequality. How do you measure? What are the metrics for measuring income inequality? What are those factors responsible for having high level of income inequality in a particular country? Look at nations with very low income inequality levels, and what are those, like we always do, like what are those lessons that we can learn from countries getting it right? But it's also important to note that while income inequality within countries is worsening, income inequality between countries have improved. However, inequality within country is very important because this speaks to how people feel, the pressure that people feel daily, on a daily basis, on a weekly basis, on a monthly basis. Any country will want to reduce the level of income inequality among the citizens, because it has its adverse effects, on the standard of living, on the health status, on a lot of factors, and definitely overall level of development of the country will be affected. So one of the merits role of financial inclusion is going to help reduce income inequality. Why do we need financial inclusion in a country? Why do we need to deploy strategies? Why do we need to keep on measuring? Why do we need to be deliberate about putting tools, infrastructure in place to enhance high level of financial inclusion? Because it has the capacity to strengthen or improve financial stability. Yes, because we've established that financial inclusion will help to reduce poverty levels. We've also said that if we have high level of financial inclusion in the country, it will help to reduce significantly income inequalities in the economy. Definitely, reducing poverty level, income inequality will help to build relatively more stable economies, and this will help to improve financial stability, of that country. Yes, other countries where financial inclusion levels, high levels, have helped, to bring about a bit of financial stability. Has it helped? Yes. Has it contributed to economic growth? Yes. We have the issue of, according to World Bank report of 2020, Rwanda financial inclusion initiative contributed to economic growth with a GDP growth average about 7.6 between 2010 and 2019. And I tried to look at what they did in Rwanda differently. There was a program. They had increased access to financial services through a program called the Umereng SACCOS Initiative Program. And what this program did was that it increased the percentage of adults with formal financial services. As at 2005, they had about 48%, of adults having access to formal financial services, and as 2020 it shot up to about over 90%. So from 48% to about a little slightly above 90% in 2020. That is the space of a decade and a half, less than 2 decades. And what this program did, the Umereng SACCOS Initiative Program, what it did was it provided access to affordable credit to a wider population range. So access to credit, improve the level of financial, strength, improve the level of financial stability of individuals or businesses, and this resulted into a significant growth, level of their GDP between 2010 and 2019. Why is the emphasis of financial inclusion? Another is that it encourages entrepreneurship, because increased access to capital would facilitate the transformation of ideas to realities, to economic entities. People have brilliant ideas. No matter how brilliant you are, no matter how good your ideas are, if you do not have capital, in most cases, to execute, to transform the idea to realities, either to provision of service or you are producing a good, it just means ideas with no economic benefits. Thus, targeting brilliant minds in unbanked, rural, and improvised places would help to build the level of entrepreneurial spirit, capabilities in a nation. The focus is about turning beautiful, ideas into economic entities, into production of goods or provision of services that would add economic value to a nation. And the last but not the least benefit of financial inclusion in a country is that it could help to build and sustain transgenerational wealth. It helps to build wealth that can be passed down from one generation to the next. To build foundation underlying wealth, you need access to financial services like mortgage, because it becomes the channel for passing down wealth from one generation to the other. Well, this is all that I can take on today's episode of our program series, Financial Inclusion and Economic Development. I've enjoyed myself. I hope you have learned one or two things. Thank you so much for joining us. Remember to join our other programs that runs from Monday to Thursdays, same time, 5 p.m. WAT. You have my colleagues that are coming up, with very informative, insightful, expository episodes every day, daily. I hope that you join us so that you can learn a lot from all of these rich and enlightening episodes and programs. Thank you so much. I hope that you join me same time next week, 5 p.m. WAT. And remember, if you have any questions for us, any suggestions, your feedback, the reason why we do this, we appreciate all of this. Kindly remember to send all of your questions, your feedback, your suggestions to contact@thearmorgate.org. The email address is contact@thearmorgate.org. Remember, financial inclusion matters not only because it promotes growth, but because it helps ensure prosperity is widely shared, and also that wealth can be built and can be passed down from one generation to the next, till I find my way to your devices again next Friday, 5 p.m. WAT. I remain Titilola Ogunsona saying bye from here.